While most people are watching this video going, why the hell would I want more debt? I want you to keep an open mind as we approach this video and my findings. The reason I love debt so much is because it allows me leverage to go into assets and grow a bigger position by working smarter, not harder. If you want me to explain this with my whiteboard, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now in a second here, we will go through my whiteboard and just break down exactly why I like debt so much. Why I think the rich get richer by using debt productively. And despite me coming out on the channel and saying your own place is unproductive debt, which means it's not an asset, I want to flesh that out because there is a way that you can turn your own home into a productive asset and thereby going towards financial freedom even faster. So let's jump in. So the question around debt is mainly around, well, is it good to take on debt early when you're young or is it better when you're older? Well, this really just depends on your earning capacity as well as your own mindset and your own strategy. So it doesn't really matter when you're taking on that debt. Yes, there's going to be optimal times to take on more risk than other times, but what I'm going to do is break it down with my own perspective being 30 and with the majority of you being aged between 25 and 35, I think most of you guys will see it in the same way. Now, the reality behind buying real estate here in Australia is that you can go out and do it in two ways. Number one is you can do it with 100% cash, or you can go out there and use 10 to 20% in cash and the remaining amount you can go to the bank. And what's very interesting is when you go to a bank and you say, hey, Mr. Bank Manager, I would like a loan, they would go and push you towards a credit card or a personal loan, and the interest rates on them are horrific. So you could be paying anywhere between 15 and 20% in interest rates. But as soon as you go in and say, Mr. Bank Manager, I'm actually looking on taking on debt, so I want a loan, but it's because I want to buy a house. Suddenly they just go ka-ching! Their eyes light up and they go, yeah, no worries, we'll give you a loan for about 5 or 6%. And not only that, but you put down 10%, we'll put down the next 90%. So understanding the rules of the game from the bank's perspective can mean that you can take on debt a lot cheaper than what most people can. Now, not all debt is created the same, and we often refer to this as bad debt or unproductive debt. And what could that look like? Well, if you go out and get a car loan, you go and take out a credit card debt to go on a holiday, or your principal place of residence. As soon as I say principal place of residence, people get defensive and they're like, well,
I own one of those. How can you say that's unproductive debt? Like, my property's growing in value. You're an idiot, Ravi.
Well, what I mean by this is that it's not yielding a cash return for you. But the question you need to ask yourself is, can the debt that you accrue with unproductive debt become productive? Now, in all of these cases, I'm going to go and argue and say, yeah, you can. Because in the case of a principal place of residence, if you go out and you simply purchase the home to live in, yes, it's unproductive debt. It is not an asset. But if you go out there with the intention that, hey, if the property goes up in value, I'm willing to use the equity to purchase more properties, or I'm willing to go and use that equity to build my own business, then it does become a productive asset. So I just wanted to flesh that out. Now, when it comes to the holiday or the car, you're probably wondering, scratching your head going,
how does this become productive debt?
Well, it can, because imagine you took out a loan to get a car, but the car serves the purpose of you doing Ubering, or goes and serves the purpose of you running it in your company. Now that one asset now produces you income, which therefore means that unproductive debt is now productive. And when it comes to a holiday, well, imagine if you're a content creator and you're relying on you traveling and doing travel vlogs and things like that to earn an income. That then would become productive debt as well. The whole point I was making earlier around keeping an open mind, and if you've been following the channel, that's all I advocate for is, yeah, you can go out there, buy real estate, buy stocks, buy trading cards, do whatever you like, but keep an open mind when someone comes to you with information, because although we've been taught for the last 20, 30, 40 years that we should go and approach debt the same way like everyone else, and don't go do a 9 to 5 or do a 9 to 5, do side hustles, don't do a side hustle, you've got to figure out all of these options that are available to you. You've got to figure out which one is the best for you. Now, on the whole idea of leverage and working smarter, what we've got to do is understand what our destination is, and it's usually financial freedom. How do we have more choice? And that doesn't mean that you can go and retire at 35 and sit on a beach and do nothing. I'm telling you, like, it gets so boring when you do nothing for a while. And just with your mindset, if you're young, you want to be doing things. It leads to productivity. That productivity means you're growing, and then that actually gives you fulfillment. At least it does for me. If it does for you, smash that like button. Now, let's say tomorrow you decide you're going to go to work and you've got a couple of options. You've got the option to walk, take a car, or take a plane. Now, I'm not sure how far your work is, but I'm pretty sure you're not taking a plane to work. And depending on what the location is how you'll decide the mode of transport. So in this case, if I'm looking at real estate, I would go out there and say, I could go and buy this 100% cash, but I'd have to save for much longer and hope that my savings rate is higher than the growth of that property, because every time that property grows and I'm unable to get in, I'm falling further behind. So if my savings rate is 5%, but the property is going up by 7%, I'm still losing year on year. But if I decided, well, I want to go and take a faster mode of transport, so in this case, you could walk to work, which could take you maybe 30 minutes, but if you go in a car, it could probably take you 7 minutes. You're now leveraging time, which is in fact your biggest asset. The same thing you could do with real estate, and is why I like debt, like productive debt against good quality real estate. Now let's run some numbers and to really understand why real estate is so important and how you can actually get to financial freedom without having to buy 20 or 30 different properties. You can actually do this quite easily depending on your time horizon. So we know that on average in Australia, property grows at 6.8% compounding annually. So if we go ahead and use $80,000, we could go and purchase a property for $450,000 in 2023. Now where it gets interesting is with that compounding growth, you've gone ahead, you've purchased your property and say, I don't want to know about it. You know, it's going to manage itself, neutral cash flow at worst. What is it going to look like? Well, in 10 years, it'll be worth $868,000. In 20 years, it'll be worth $1.67 million. And in 30 years, it'll be worth $3.2 million. Now, even if you went ahead and said, I'm going to take out the debt at 90% and never pay a single dollar down, I still now control an asset worth $3.2 million in 30 years time, and my debt remains the same. Maybe it's $350,000, maybe it's $360,000, but that is very powerful. And what we can do is take it a step further. When I talk about building a machine, building out this financial freedom machine of properties and a property portfolio, what does that look like over the next couple of years? Well, let's break it down. If you decide to buy one property in 2023 for $450,000, a very comparable property would be probably worth about $480,000 the year after. Year after that would be $513,000. After that would be $548,000. And then finally, after 5 years, it'll be worth $585,000 roughly. So if you decide every year to go and purchase one property every single year, and it was a comparable property to the first one, this is sort of what you would be expected to pay. And that would equal $2.16 million of real estate. You've gone out there and you've said, look, I'm going to buy one property every year for the next 5 years, and each one's going to be worth about $450,000 in today's value. So as we've gone through, by the time you're purchasing your fifth property in year 5, it's actually worth $585,000. And you can already see that that first property is now worth $585,000 as well. You would have enough equity to go and purchase those following properties. So you wouldn't actually have to use your own money. And if you want a detailed breakdown of how equity works and how you can use that to build a portfolio, definitely go check out this whiteboard video. So let's say you do that over the next 5 years. You go ahead and say, well, what's it worth in 10 years? It's actually worth 4.17. Now the numbers get pretty wacky now. After 20 years, it would be worth 8.05 million. And in 30 years time, it would be worth $15.5 million. And before you sort of go, well, yeah, okay, that sounds great, but what about inflation? What's $1 million worth in 30 years time? And I would go on to argue that's the same way that you got to approach the rest of your thinking when it comes to your portfolio. I hear so many people often talk about how you can dollar cost average into the markets like ETFs and things like that. And by the time you're 30 or retire, you'll be a millionaire. Yeah, great. But how much is a million worth at that point? And I would go to say, well, yeah, 15 million in today's terms is definitely not what it's going to be worth in 30 years time. But what you want to know is if inflation's at 2 or 3% and you can consistently outperform inflation by say 2 or 3%, given that inflation probably going to be 2 to 3%, but the average growth is 6.8%, it means you're still getting further and further ahead, which means although $15 million will still not be worth $15 million worth today in 30 years, it would still be a hell of a lot more than if you were to go out there and just save your money. Now, here comes the craziest part. If you assume a 10% deposit and 5% for your upfront costs, like say you wanted a buyer's agent, you wanted to go and get stamp duty sorted, and you'd have pest and building and things like that, your upfront cost to buy the entire portfolio today would be worth $324,000 in cash. Now, some of you may be watching and going, I've already got $300,000 in equity. I've already got $300,000 in the bank. Does that mean I can go and execute on all 5 years now? Yeah, you can definitely do that. If you're interested in building out that portfolio fairly quickly, definitely book a free call. There's a link in the description below to my website where you can book that call, or equally, you can go and email me. There's a comment pinned down below. Now, when we go out and purchase property, we're looking ideally at positive cash flow property. So properties that are yielding yielding more income than the expenses that that property incurs. So in this case, even if we looked at the worst case scenario of a neutral cash flow, which means all the expenses are covered by the income and nothing out of pocket, that means that we can assume to do this with an upfront payment of $325,000, create the entire portfolio today, and then we can assume a 5% yield, which in today's value at 2.16 million is about $108,000 in rental returns. But when we do that on 5.5 million, which will be in the future 30 years, that would actually be $775,000 of rental income coming through to you every single year. The fact that wage growth now is peaking at about 3%, at the best case you're getting about 3 or 4%, you can clearly see that if properties are performing at 6.8% and you're getting wage growth of about 3%, you're better off having that money stored in investments and hard assets, especially given the fact that we have such a severe shortage, not only in the short term, this is going to compound and become even worse over the next 5 to 10 years. What's even crazier is that I can use the debt today, and let's say I purchased the $2.16 million worth of real estate today and decided I'm not paying a single dollar of debt down. I can go in, refinance every 5 or 10 years when my interest only period ends. I can do it again, do it again, do it again. And then I go, well, in 30 years time, my portfolio is going to be worth about $15 million, but my debt is still going to be worth $2 million. But if now my rental income is worth about $700,000 a year, I could simply use 3 years of rental income and pay off the entire amount of loan instead of having to do that every single year. Now, again, I'm not a financial advisor. I'm some guy who draws on a whiteboard, makes videos for you guys in a black t-shirt. So just understand that when we're going through these things, you've got to now factor in how important is financial freedom to you, and are you picking the right assets when it comes to building your wealth? Because you can see how powerful it is, and I urge you to watch this video again, save it somewhere, because I promise you, these are the sort of opportunities where things align, you're able to get a loan, you're able to get good quality real estate. You should go out there and do these things. Now, the final question I have for you is, how do you actually execute something like this? It's all well and good that you want to go out there and say, purchase property for yourself. You go out there and say, okay, I've purchased one, but now how do I purchase the second one? And what happens if it doesn't grow by 6.8%? What happens if it grows less than that? In our case, when it comes to the buyer's agency, we're recording numbers way beyond this, anywhere between 11 and 14% when it comes to annual growth rates. So if you're after speed and you want to do this by outsourcing it completely and going, I only have to do this 4 or 5 times. And then after it's set for life. And I can go in, have the property managers manage it. As the properties grow in value, I can then have more choice, especially with my lifestyle and what I decide to do with my time. If you need that extra help, again, pin comments, email me ASAP, because the demand for our services are going through the roof, which is fantastic. And I'm very, very grateful for all the support you guys give us. But it is very important that if you're wanting to make these moves while the good quality real estate is available, go and do it. Because when these markets change, and they will, and they shift, that is when you want to be on the right side of it. So if you're interested in speed and you want that help, definitely smash that like button, definitely subscribe, and I'll catch you guys in the next one. Thanks, guys.